Cash flow versus appreciation. What matters most in Orange County multifamily real estate? If you're looking to buy a multifamily property here in Orange County in 2025, you might be asking yourself, what's more important? Is it cash flow? Is it appreciation? What are some of the trade-offs when considering a property that has more cash flow versus a property that has more appreciation, and kind of what makes the most sense for you? So we're going to unpack this in today's video. Orange County, typically prices are high, cash flow returns are typically lower, and we have seen historically great appreciation in this marketplace, which is why it makes it such a sought after market for multifamily investing. So you might get higher returns on cash flow if you're buying in the Inland Empire and some bordering markets in LA County. You might also get more appreciation when buying along the coast. We've seen the coastal markets just continue to be such a growth market. However, you're going to probably see more neutral to negative cash flowing assets, at least for the first couple years when buying some of these coastal properties, potentially, especially if they need a deep renovation. So let's dive in. Let's talk about the appreciation. The pros with appreciation. It's a long-term wealth builder. There's been so many multifamily owners long-term that have built tremendous amounts of wealth just acquiring properties that have appreciated over time. Look at the coastal markets, for example. You buy in a great area, right? You see the area continue to keep improving over and over again. Your property is going to get lift from that. Your property's rental rates are probably going to go up if the area is getting better. If there's single family homes, I love buying around properties that have a lot of single family homes around them because typically there's going to be a lot of owners in the area. They're going to keep up their properties and the areas are going to continue to keep climbing and getting better. So with that, you're going to likely see properties appreciating really well. Compared to properties that maybe in an area, if you bought in a rougher area, the property might not appreciate as much. Maybe it's about the same as it's been in the past 10 years. If you've driven down the street 10 years ago versus today, if it looks the same, probably the area is not going to be appreciating as much. So again, look at buying in great areas. You can fix your property, but you can't fix the location. And then also, this is ideal for legacy investors, long-term owners that are looking to build cash flow, maybe as a second part of their journey. Their first part of their journey, they're focused on their net worth. So we've seen a lot of investors, that's a lot of the pros, but we've seen a lot of investors acquire a property along the coast. They built up a ton of equity in their property just through appreciation. Maybe they haven't cash flowed a ton off of it, but then they can 1031 exchange if they want to and get into a cash flowing property. And that's what we've seen a lot of people off the coast selling, getting out of a lower return on equity property that's done well for them, and then getting into a higher cash flowing asset, especially when they're looking to retire. Possibly they're looking to step out of their job, their JOB, their earned income, and they want to have cash flow to replace their earned income. So that's definitely the pros to appreciation. But then there's also some cons with appreciation, right? Number one, appreciation is not guaranteed. There's no for sure thing on appreciation. We all know there's market cycles. Markets go up, markets go down, and if you buy in the wrong time of the market, you could see the equity erode from your property, or it could just be flat. So you need to be cognizant of that, right? And then also properties that are appreciating well or have a historical likelihood of appreciating often don't cash flow as well. So that's also a concern there. So you have some market risks and you also have some risks with little to no cash flow. It's hard to have a property that cash flows super well and appreciates super well. So typically we're breaking this down to looking at one or the other. Okay, so also if you're buying properties that appreciate well and they don't cash flow well, it's really hard to scale that strategy, right? It's really hard to have a strong, unless you have a strong income, maybe your earned income, it's hard to continue to keep buying properties that don't make little to no money. There's only so many of those properties that you can keep buying. And then also when it comes to appreciating properties that do very well long-term, we start to see a lot of owners having an emotional connection to the property, an emotional hold. I totally understand. It totally resonates with me as well. You know, investors sometimes hold on to an appreciating property sometimes too long. Sometimes it makes sense for them to level up and 1031 into another property or possibly sell. It all depends on their their circumstances, their situations. But some people hold on too long sometimes, where they could have been better off having a better need for the money and they held on too long, or they're just worried about, really the burden of taxes, right? I mean, that is a big concern with a lot of owners. They have built up so much equity, but then it's like, what do I do when I sell? I owe all this money in taxes. So there is an emotional connection to the property. All right, looking back in 2018, there was a duplex that sold on Newport Beach Peninsula for $1,355,000. Now that property is worth an estimated of $2.7 million. And likely the cash flow per month was on average about $2,000 a month. So there was a 1.35 million approximate appreciation in equity gain. So that shows an example of a property that's going to likely appreciate very well over time, cash flow very little. But that property is pretty much doubled in value and cash flowed a little bit. So that duplex, whoever bought this duplex, has done really well on that property. And again, that's a 7-year hold, but that's an example of a property that's going to be appreciating very well. So let's dive in on the second part of this video, which is cash flow. Look, the pros of cash flow, the number one, cash flow is the lifeblood of any business. It's putting money in your pocket. That is the most important thing of keeping the lights on, having a profitable asset that makes money. This also allows an investor to weather the storms. If there's a down cycle in the marketplace and you bought high and you don't want to sell, you're not forced to sell. If you're cash flowing on your property, you're making money, you can put money back into the property, keep it up, right? Provide a good quality home for the residents, and then also pay your bills. You can ride through the market cycles. You're not forced to sell. Reliable cash flow can also eventually replace your earned income, right? There's so many investors that we have sold multifamily properties to over the years while they were working their W-2 job or their 1099 job. They started tucking away and buying multifamily real estate. Well, eventually now they're up to an age where they can retire, hopefully early, from their job and live off the cash flow they're receiving off the apartments. They can work less, they can pursue new adventures. This is what's so important, to see somebody really have their lives changed by investing in multifamily real estate. It's largely done through cash flow because that is a reoccurring revenue source. Also, lenders love cash flow. Lenders love strong income, right? This can help you qualify for more loans. This can help you refinance existing properties. There's been so many investors over the long term that have went out and bought real estate. Their income has increased on the real estate and they've been able to borrow against the property, pulling out cash to buy more real estate and build up their portfolio. This is huge within the marketplace. We're not seeing this right now because interest rates are elevated. We're not seeing a lot of cash out refinances. However, that has been a very profitable and sound strategy for decades. So we hope that comes back to the marketplace. All right, and then also cash flow. Cash flow gives you peace of mind, right? If you know that a property pays for itself and some, it's really going to give you stability within your investment and just throughout your life. So I think that's really important to note. Everyone loves cash flow. Now, some of the cons of cash flow, there are some cons, believe it or not. So cash flowing properties often are in areas where you might not see as much appreciation, right? They might be in lower growth markets. They might be in maybe less desirable locations, possibly, like these high cash flowing properties. They might be in less desirable locations. They might be in areas where you might experience more tenant turnover. It might be more management intensive, right? And with more turnover and management intensiveness, you might have more turnover costs, and it just might be a little bit more of a job. You got to focus on it. So those are things you got to factor in. Here's an example of a cash flowing property that's not going to see as much appreciation. This is a 6-unit property that sold for $1,330,000 in 2018. The likely cash flow estimates are about $5,000 a month, but the property is only appreciated to an estimated $1,650,000 over the 7 years. So again, comparing that to the Balboa duplex that sold in Newport Beach, you're seeing the big swings from a lot more cash flow, little appreciation in the Fullerton property, but that was more dependable, higher likelihood that you will receive cash flow. Nobody knew that the duplex was going to necessarily double in value. Maybe not a lot of folks knew that was going to pan out that way. So there's some risks there, but kind of a way for you to find your own path as we kind of unpack some of this. What really resonates to you and what really aligns with your investment strategy. There's no right or wrong way. It's just you got to weigh the pros and cons to see what works for you. And then that moves into the last section of the video, is the hybrid strategy. This is really merging both cash flow and appreciation into one property. You might not have that explosive cash flow or that explosive appreciation on a property like we see on the beach properties, but really finding a market, a little sub-market, and a property that's gonna rent very well. You're gonna see rent growth in the type of product you're buying. You're gonna also be in a great area. Maybe it's an adjacent market to the prime coastal market, such as Eastside Costa Mesa. I've always loved Eastside. The market just continues to keep getting better and better. Good retailers are coming in, and that's constantly improving. Better restaurants, better retail, and you've just got such great proximity to everything. And also, homeownership is so expensive right now, it's out of reach for a lot of folks. So renting in this area still can provide such a great lifestyle, great proximity to everything we're talking about. So that's why we've seen good appreciation out of owning apartment buildings in Eastside, for example, and then also the rental rates. You're giving up a little cash flow, but you're getting a great piece of real estate in a great location. So I personally really love the hybrid approach. You can also compound into higher growth properties. Maybe you buy in a market like this, you could either do a cash out refi, or you decide to 1031 exchange and go up into a larger property. Maybe you double down in the same market, but you have built up so much appreciation that you can roll into the next property. And you can do that, you can do a 1031 on any property you want, but I've really seen a lot of folks build wealth and cash flow and weather the storm, but also get some upside, and I really like that strategy. So let's look at an example here, which is a 3-unit in Eastside Costa Mesa that sold for $1.3 million back in 2018. And again, all the properties that I compared to each other, they all sold in 2018, and they all sold for around $1.3 million to give kind of an apples to apples comparison. So that $1.3 million triplex in Eastside Costa Mesa is now worth an estimated $2.2 million. And the cash flow monthly on this property is estimated at $3,500 a month. So it's a little bit higher than the beach property, and it's a little bit lower than the property in Fullerton, but the appreciation is about a $900,000 equity gain, so still a great equity gain. And I think what's really nice about this is if you can get a good little property like this, you're not gonna hopefully have a bunch of tenant turnover and a lot of management intensive, more units. You're gonna have a property that's a little bit more management intensive, right? So I think the goal is, yes, more units, right? But not necessarily, especially right now where a lot of owners are, kind of need to keep running their business, but they're kind of over managing units. So it's like, well, how do I grow but not have to keep managing more and more units and build up a staff? Well, it's like, well, if you can get into kind of some of these bedroom community coastal markets where the rental rates are higher, for example, you might still cash flow about the same, but you don't have to, it's not requiring you to have as many units. So that's another reason why I like the hybrid strategy. So again, there's no one size fits all, right? There's no, you got to do it this way. It's really knowing your goals. It's really looking at and saying, do I want cash flow now, or do I want to build my wealth later? What's more important to me? It really depends on your situation. And if you want to unpack and talk your situation and how we possibly can help you through your journey, maybe it's acquiring your first property, maybe it's helping you through your first 1031 exchange, maybe it's just talking through and brainstorming what does the next 5-10 years look like and how can we help you build a really good portfolio in the Orange County market. If any of those apply, please reach out to myself or our team. We're here and happy to help. Thanks so much for watching, and we'll see you again soon.